Chapter 7, Part 3, Solving for Bad Debt Expense, Factoring with and Without Recourse. So now let's take a look at an example where we have some of the information, but we don't have all the information. So we got to use T accounts and plug. So we have net accounts receivable on the books, and of course they have a note that tells you that they have allowance for doubtfuls of 85 for 2003 and 94 for 2004, which means these numbers are net of those numbers. They tell us how much we've had in sales, credit sales, and how much was collected. So we're going to answer these questions. What is the amount of bad debt? What is bad debt expense? What's the percentage used? And what if they use direct write-off method? So, determine the beginning and ending balances of accounts receivable. Well, the beginning accounts receivable, we have to add in the allowance for doubtfuls. And for the ending, we have to add in the allowance for doubtfuls. And now we know the balances in these two accounts, beginning and ending balances. Now we also know that we had credit sales of $92,154 and they paid us $91,868. So how much bad debt was written off? We're going to take our beginning balance, accounts receivable, plus the sales minus the payments gives us a balance of $12,742. But we know that's not our balance, it's $12,578, and the difference must have been bad debt write-offs. So now we have the actual bad, and we also know that would have been a debit to allowance for doubtfuls. Now, how much was bad debt expense? Well, we take the allowance for uncollectibles balance minus the write-offs minus the ending balance, tell us actual bad debt expense. No, I'm sorry, estimated bad debt expense was $173. Now, what you always want to do when you finish this is make sure that your debits equal your credits. Now, what was the percentage used? Well, you would take the estimated bad debt expense divided by credit sales, so we have an estimate of 1.88. What is bad debt expense using the direct write-off method? It would be 164 because that is the actual write-off. And there would be no amount netted against it, so accounts receivable would be the $12,578. Now let's take a look at factoring of accounts receivable. This is when a company needs their cash right away, so what they do is they sell their accounts receivable to a third party who's going to collect them, and they charge a fee for this. Now, there's two ways they can do this. In one way, the buyer cannot ask the seller for more money if the accounts receivable are not all collected and the buyer assumes the risk of bad debt. The accounts receivable are removed from the seller's books. The second method is sale with recourse. The seller assumes the responsibility of bad debt and must record the estimated liability for bad debt. The accounts receivable are removed from the seller's books. Now, under the international standard, the accounts receivable remain on the books of the seller, and instead of a liability, is created for the factored amount. So that's how it works on the international standard. So let's take a look at an example. In this example, a company transferred $100,000 of accounts receivable without recourse. The buyer remitted 85%. When the buyer collects the receivable and retains 15%, it will remit the retained amount, which has a fair value of $11,000 less a 3% fee. So what are our journal entries? Well, first of all, how much did they get? I'm sorry, wrong way. Okay, the cash would have been the $100,000 times 85%. That's how much cash they received. Now, the receivable factor, the receivable from the person who bought your receivables is going to be the fair value minus the 3% fee, which is on the total accounts receivable. The loss on the sale is going to be the difference between the amount that was retained versus what you're actually going to receive back of that amount. And that's your loss on sale of receivables. And then your accounts receivable comes off the books. Now, what happens if they have recourse, but in this case, they pay the fee up front? So the cash is going to be 100,000 times 82%. Receivable from factors is the fair market value. We don't adjust for the fee because we've already paid it by getting less cash up front. The recourse liability is 5,000. The accounts receivable is 100,000, and the loss is going to be 12,000. Now, what about under the international standard? The cash would still be 82. They would say 3% was a finance fee, and they'd set up liability financing arrangement. And if you notice, the accounts receivable do not come off the books. Now, the last thing we're going to look at is how to do a bank reconciliation. Now, since all cash receipts are deposited in the bank account and cash disbursements are made by check, the bank account provides a separate record of cash. And what you want to do is always make sure you reconcile these. Why? Because there's going to be a difference because of timing between the cash book and the bank balance, and because of possible mistakes. So the first thing you always want to do is adjust the bank balance to the correct cash balance. And the adjustments that you're going to have are checks that were issued that haven't cleared and ones that cleared from the previous month that didn't clear last month but cleared this month, and maybe bank errors. Once you come up with that number, you're then going to adjust, look at the book versus what's on the bank statement. And again, timing tends to be the issue. So here's the formula. Usually you take the balance that's on the bank statement, you add in deposits that have been made but not recorded by the bank, minus checks that have been issued but haven't cleared yet, and plus or minus any errors, and that gives you the adjusted bank balance. You do not do journal entries for the adjusted bank balance. If there's errors, you call the bank. Then you're going to do the book. You're going to take the balance per book plus collections by bank that weren't recorded, minus service fees, minus non-sufficient fund checks, plus or minus errors. These you must always make journal entries for. And remember, these two numbers have to be the same in the end. So let's take a look at an example. Now here you have a bank that has a cash balance of $38,018 at the end of the month. It includes service fees, NSF, and monthly note payment deducted from the account. The books had a balance of $38,918 with deposits outstanding of $6,300 and outstanding checks of $8,400. Check for $30 was incorrectly processed by the bank for $300. A payment from a client for $2,000 was recorded as $200. So let's take a look. And remember, we always start with the bank. So balance per bank is $38,18. We have to add in the deposits in transit. Again, these are deposits we've made, but the bank didn't catch because of when they cut off. Checks outstanding, these have not cleared the bank, and then we have our bank error. This is the adjusted bank. And again, to fix the bank error, you have to call the bank. The books. There's your beginning balance. We're going to add in the cash receipt error. And we're going to deduct the non-sufficient funds check, the notes payable, the interest, and the service fee. And if you notice, we balance. Now, to fix these, we have to do journal entries. And again, these both must equal. Now let's look at our journal entries. And this is what they would look like. So, that's how you do a bank reconciliation.